Hey everyone, and welcome to this whiteboard-style revision explainer. I am so excited to be your guide today as we build your absolute A-star blueprint for the IGCSE Accounting 0452 module. We're specifically tackling irrecoverable debts and recovery today. So if you're targeting top marks for the 2026 syllabus, you are in exactly the right place. We're going to break down this kind of complex topic into super clear, manageable pieces. All right, let's get right to work. So here's our A-star roadmap for today. We'll start with core accounting concepts, move into step-by-step technical execution, look at interpretation and ratios, and finally, wrap up with examiner insights and strategy. Let's dive straight into Section 1, Core Accounting Concepts. These are your fundamentals. Okay, so for the 2026 syllabus, Cambridge has officially transitioned to modern international terminology. What does this mean for you? Well, it means you literally must use the terms irrecoverable debts and owner's equity with 100% accuracy. If you use outdated terms, like the old bad debts, you really risk throwing away crucial marks. So strict adherence to this new vocabulary is absolutely non-negotiable if you want that A-star. Now, the core of everything we do, the literal foundation, is the accounting equation. Assets equal liabilities plus equity. The business entity concept says we have to maintain this equation at all times during the fiscal period. Think about how this applies to our topic today. If you write off an irrecoverable debt, you are decreasing an asset, right? Your trade receivables go down. So to keep things in perfect balance, your equity has to decrease too, reflecting that loss. Every single adjustment has to honor this duality. Understanding the prudence concept is super essential here. Let's compare it directly to a really dangerous mistake: overstating profits. Imagine a customer goes bankrupt and they just cannot pay you. If you ignore that loss, you're artificially inflating your profits. Anticipating and recording that irrecoverable debt immediately, that is exactly how you apply the prudence concept in the real world. You basically never want to let the accounts look better than reality. To successfully navigate the really complex business scenarios you'll see in Paper 2, you need a razor-sharp vocabulary. Let's do a quick rundown. Accrued simply means an expense incurred but not yet paid. Prepaid is an expense paid in advance. Realization is when you recognize revenue only when it's officially earned. And consistency? That means using the exact same accounting policies year over year. Honestly, mastering these definitions is what separates a good student from an elite accountant. All right, moving on to Section 2, Step-by-Step Technical Execution. Let's look at some methodological approaches. Okay, when you see the IGCSE command word calculate pop up on your exam paper, securing your method marks has got to be your absolute top priority. Examiners will actually award you method marks even if your final balance is completely wrong. Seriously. But there's a catch. Your logical flow and your workings must be fully visible. So whether you're calculating the exact figure for an irrecoverable debt write-off or adjusting for depreciation, show every single step of your logic. Let's apply this process flow to a real scenario. If the command word is state, the exam might ask you to, say, state the source document for a written-off debt. The answer? It's the journal voucher. That document feeds into the general journal, which is your prime entry, and that then posts directly to the irrecoverable debts T account. From there, you extract the balance to the trial balance, and it finally ends up in your income statement. See? It's just a seamless, logical journey from start to finish. Now, the exam command word here is often prepare. For instance, prepare the trade receivables account. Let's say a debtor owes you $500 as a balance brought down, but unfortunately they go completely bankrupt. You have to credit this T account to close their specific ledger, which brings the balance carried down to zero. The corresponding debit goes straight to the irrecoverable debts account. Just a heads up, mixing up your brought down and carried down stages is a totally classic error. Remember, the carried down balance closes the period while the brought down balance opens the new one. To avoid some really common mathematical pitfalls, you have to clearly distinguish between trade discounts and cash discounts. Trade discounts happen right at the point of sale, whereas cash discounts happen at settlement. Tying this back to irrecoverable debts, if a customer gets a cash discount for paying part of their bill early, but then later defaults on the rest, the irrecoverable debt you write off is strictly the exact dollar amount left unpaid. It's not the original invoice total. Keep those calculations totally separate. Next up is Section 3, Interpretation and Financial Ratios. This is your Assessment Objective 3 stuff. Okay, it's time for a little interactive practice. I want you to literally pause this explainer right now, grab a pen and really think about this question. Why might a business's current ratio fall drastically from 2.5 to 1 all the way down to 1.1 to 1? Like, what underlying business activities would cause such a sharp drop in liquidity? Pause now, take a few seconds to write down your thoughts, and just unpause when you're ready. Welcome back. All right, let's reveal those diagnostic answers. If you wrote down that inventory might have been overpurchased, you nailed it. If you noted a slow settlement of trade payables, spot on. Or maybe cash reserves were heavily depleted because of a massive capital expenditure. Thinking like this is exactly how you tackle and evaluate or suggest question on the exam to secure those high-level AO3 interpretation marks. Another super vital part of interpretation is inter-firm comparison. And honestly, this can be incredibly tricky. Why? Because different businesses use different accounting policies. For example, one business might use the straight-line method of depreciation, while a direct rival uses the reducing balance method. You really have to look beyond the surface numbers and analyze the true quality of the profit before you even attempt to compare two different firms. And remember, not everything fits neatly onto a spreadsheet. You've got to evaluate non-financial factors too. Things like staff morale, physical business location, and market reputation are completely invisible in the accounting records. Yet these factors are absolutely vital to a business's long-term sustainability and their return on capital employed. Weighing these non-financial factors right alongside the hard data, that is the true differentiator between a B-grade answer and a flawless A-star performance. Finally, we've reached Section 4, Examiner Insights and Strategy. Let's talk about how to actually win the game. So, I need to deliver a very stark, serious warning, pulled directly from the recent Principal Examiner reports. Quote, "Marks lost through poor handwriting in ledger accounts." I know, it sounds so basic, but it's tragically common and, best of all, completely avoidable. Please do not lose easy marks simply because the examiner physically cannot read your brought down or carry down figures. Write clearly and always double-check your legibility. Here's another major pitfall highlighted in the examiner reports: the absolute failure to distinguish between revenue items and capital items. This applies heavily to our topic today. Say a previously written-off debtor unexpectedly pays you back. That is revenue income. If you incorrectly list the recovery of a debt as a capital receipt, you're going to unbalance your entire statement of financial position. You need 100% accuracy right here. Let's lock in those maximum points with a rapid-fire checklist of exam day strategies. Do, master your time management. Do, respect the question weightage. Never, ever spend 20 minutes agonizing over a 3-mark calculation. And definitely, do include your state symbols, even when you're working on specialized modules like manufacturing accounts. Following these exact steps ensures your trial balance phase will be perfectly accurate. To wrap up our whiteboard explainer today, I really want to leave you with a real-world thought. Think about this. Are your final financial records transparent and accurate enough to guide the massive decisions made by banks, owners, and tax authorities? When you sit down for that exam, remember that you aren't just pushing numbers around on a page. You are proving the integrity of a real business. Keep your logic clear, follow those 2026 syllabus rules to the letter, and that A-star will absolutely be yours. Happy studying!